According to Forbes magazine, there were, at the last count, just over 500 billionaires in the United States. But the former hedge fund trader turned index investor Victor Haghani says therein lies a puzzle that has important implications for how we invest. Here's a clip from a TEDx video he presented called "Where Are All the Billionaires and Why Should We Care?"
Let's start with this fact. $1 million invested passively in the US stock market in 1900 would have grown to $30 billion today. Ka-ching. Now, you might say, wait a second, $1 million was a lot of money in 1900, and you'd be right, it was. However, historical records indicate that we had 4,000 millionaires in the US in 1900. Now, if each one of those millionaire families had children at the average rate, we would have 30 families living today for each one millionaire family back then, which conveniently means that those 4,000 millionaire families in 1900 would have spawned 120,000 billionaire families living today if only their investments had been able to match the return of a passive investment in the US stock market.
The question then is, why haven't investors been able to match the returns delivered by the stock market? Well, aside from consumption and taxes, Victor says there are two main reasons. The first is the cost of investing. In other words, the commissions, fees and spreads that the financial industry extracts from investors. There's a very simple way to reduce those costs, and that's to use low-cost index funds. But most investors favour more expensive, actively managed funds instead. What are the reasons for that?
One is there's just a feeling that we as humans have of exceptionalism, that we all kind of think that we're a little bit above average in whatever we do. So the idea that hope springs eternal among people in whatever it is that we're doing, I think also applies to investing. And so despite knowing that on average actively managed funds are not going to do very well, that we hope that we can identify the ones that do well. The second thing is that as consumers, we're conditioned to feel that when we pay more, we're getting something that's better. And investing is the exception to that, where paying less is actually giving us a better outcome and a better product.
So, how much is it costing investors to use actively managed funds?
Today, probably investors on average who are not indexing are probably costing themselves 1% to 2% today when you add up all of the costs in terms of the frictions and the fees.
But, says Victor, there's a bigger reason why investors fail to capture market returns, and it may surprise you. In the words of Pogo, we have met the enemy and he is us.
I think the culprit is here, very simply put, is return chasing. It's investors moving their money slowly into whatever it is that's doing best at a moment in time, taking their money away from whatever has been doing worst. And that return chasing is a really big cause of shortfall of investor returns. And a number of different researchers have analyzed those numbers, and what they generally look at is what's called investor returns and fund returns. So they look at, if you invested $1 in a particular fund, what the return would have been if you just kept it in the whole time, and that's called the fund return. And they compare that to what they call investor returns, which is they look at the cash going in and out of each fund and look at the internal rate of return or the return on that. Well, guess what? They find 3% is very often the difference between the fund return and this investor return.
3% a year is a huge drag on your investment returns, especially when you add it to the 1% to 2% you're losing by using active funds. What then would Victor Haghani advise young investors to do?
Try to save as much as you can. Try to save 15% of your income. Put it into a low-cost global equity index fund. Put most of it into that because you're young and your human capital is more than your financial capital. So maybe put 90% of your money into that, low cost. Do it in a tax efficient way if possible, if you have the ability to do that in a tax advantaged retirement account. And just stay the course. Keep putting money in there until you're either old or rich. And then you could drop your 90% lower.
So there you have it, sensible investing in a nutshell. And if more people started to invest this way today, we'd have a better chance of avoiding the looming pensions crisis. And come the turn of the next century, there'll be many more billionaires in the world than there are today.